The world's largest economy, the US, has done remarkably well. It's avoided that much talked about recession, at least so far. Welcome to Investment Insights for February. I hope you all had a great start to the year and welcome back. This month we're looking firstly at the US economy and whether the resilience it's shown can be maintained throughout the course of the year. The second point is around inflation. Will we get to the central bank targets by year end? And thirdly, we're looking at the financial markets and the relationships between equities and credit markets. So turning to the first point, the world's largest economy, the US, has done remarkably well. It's avoided that much talked about recession, at least so far. Data coming out has been very good. And if you look at the chart I'm showing you here, you can see that in the second half of 2023, GDP has been quite robust. Now, why is that? Well, there's been a number of factors behind that. Firstly, the employment situation has been strong. Companies have held on to the workforce. We've seen unemployment still close to 50-year lows. And actually, wage gains have been fairly decent as well. So in other words, households have got a job and they're getting paid more for doing that job. In addition, since the October time period, we've seen gasoline prices fall by about 17%. And even though mortgage rates have jumped very high over the last couple of years, we have seen them begin to moderate over the last few months as expectations of rate cuts begin to get priced in. Now, it's not all plain sailing. Clearly, interest rates are still very high and there's a lagged effect. Credit card rates are about 21%. And I said mortgages are still at a much higher rate than we've become used to in recent years. So over time, we think that 2024 will see a gradual decline in terms of that growth dynamic as some of these challenges, the lagged effect, are faced. Now, turning to our second point, inflation. This is critical because it also determines what happens with interest rates. As you can see, really globally, there's been a pretty symmetrical view of inflation. It went up very quickly and it's now come down fairly rapidly as well, at least at the headline level. You can see the dotted line is the central bank's targets, and actually we're getting pretty close to these targets already. However, the service sector is still seeing prices at an elevated reading. We need to see service price inflation come down over the remaining part of this year, and wages too. While it's helping households and workers, we do need to see a moderation in wages over the remaining part of this year to feel comfortable that the central banks will indeed get to their target. So far, however, things are looking good and we suspect they'll achieve that objective. So now turning to our third point, there's no question investors have been encouraged by that growth dynamic and the lower inflation. The chart I'm showing you here is the S&P 500 index. And you can see for the last couple of years, it's been a fairly roller coaster ride for investors as the market moved up and down. But interestingly, we only recently breached the highs set a couple of years ago. But that's important. We've had a period of consolidation for the markets during these volatile, turbulent times. But now there's a bit of momentum. In other words, when you get a breakout to these multi-year highs, the likelihood is that could continue for some time. Now, while the upside for equities looks reasonable, when we turn to credit markets, we see a different dynamic and we don't think the risk-reward trade-off is nearly as good. The chart I'm showing you here, the blue line are the number of companies that have gone bankrupt, 201 last year. And what's interesting, you can see there's only been a couple of other periods really that have been worse than that during the pandemic and during the financial crisis. But during these periods, when risks have been rising because companies have been going under, you saw the spread, the credit spread, picked up. In other words, investors demanded a risk premium in order to lend to companies in riskier times. But right now, despite these pickups that we've seen, spreads remain very tight. And from our perspective, the risk is that if things deteriorate further, that spreads could move significantly higher. But if things continue to get better, as we suspect they will, the likelihood is these spreads really can't go any lower. You can see there is a floor in spread. So when we look at equities versus credit, we think the risk trade-off favors equities currently versus the credit markets. Now remember, as always, you can read the full report, Investment Insights, on our website. And please do keep the comments coming regarding the videos and how we can improve them.